This CTA screencasting project is supported by the South African Institute of Chartered Accountants and the Auditor General of South Africa via the Tutuka program. When determining if a transaction is a business combination, the first step is to determine whether the assets acquired and the liabilities assumed is a business. To determine this, you have to apply the definition of a business. The definition of a business is an integrated set of activities and assets capable of being conducted and managed for the purpose of providing return in the form, for example, of dividends. If the assets acquired and the liabilities assumed do not constitute a business, you should treat the transaction as an asset acquisition. All the assets acquired and liabilities assumed should be included at fair value in the separate financial statements of the acquirer. If the assets acquired and the liabilities assumed does constitute a business, the second step is to determine whether the transaction or event is a business combination. To determine this, you have to apply the definition of a business combination. The definition of a business combination is when the acquirer obtains control over one or more businesses. To determine whether an acquirer obtains control, you have to apply IFRS 10. You can refer to the IFRS 10 slides for the definition of control. If a transaction or event is a business combination, you have to apply the acquisition method. To apply the acquisition method, you have to follow the 6 steps which I will now discuss with you. The first step is to identify the acquirer. The acquirer is the entity that obtains control. To determine whether the acquirer obtains control, you have to apply IFRS 10. Please refer to the IFRS 10 slides for the definition of control. The second step is to determine what the acquisition date is. The acquisition date is the date on which the acquirer obtains control. It is usually the date when the acquirer transfers the consideration, acquires the assets, and assumes the liabilities. The third step is to measure and recognize the assets acquired and liabilities assumed. Assets acquired and liabilities assumed should be measured at fair value at the date of the acquisition. There are certain recognition and measurement exceptions to this principle. Let's just look at the exceptions. The measurement exceptions include reacquired rights, share-based payment awards, and non-current assets held for sale. The recognition and measurement exceptions include deferred tax assets and liabilities, employee benefits, and indemnification assets. The recognition exception includes only contingent liabilities. You can refer to IFRS 3 for a detailed explanation on these exceptions. The fourth step is to determine the consideration transferred. The consideration transferred should be measured at fair value, except when the assets transferred remains within the group. If the asset remains within the group, it should be measured at the carrying amount of the assets. The fifth step is to measure non-controlling interest. NCI can be measured at the proportionate share of the acquiree's net assets or at fair value. The last step is to measure and recognize the goodwill or gain on bargain purchase. Goodwill is calculated as the consideration transferred plus NCI less the identifiable assets and liabilities at acquisition date. When will the non-controlling interest share in goodwill? When NCI is measured at the proportionate share of the acquiree's net identifiable assets, NCI will not share in goodwill. But when NCI is measured at fair value, NCI will share in goodwill. This was a summary of the acquisition method. Please refer to the standard for a more detailed explanation of each of the 6 steps. This is the end of our screencast on IFRS 3. We thank you for listening.